Almost all explanations around portfolio diversification theory inevitably begin with eggs. The ancient cliché is that you shouldn't put all your eggs into one basket. This has been heard by pretty much everyone. Because if something were to happen to that basket, well, then all of your eggs would get destroyed, and that's no fun. In this video, we'll take an in-depth look at how exactly diversification works. Specifically, I'm really excited to show you a simulation that demonstrates how a quantity of assets and their characteristics impact the performance of an overall financial portfolio. But more on that later. Let's get into it. Welcome back and thank you very much for watching. If you're new here, on this channel we talk about finance and financial markets a lot. If that sounds interesting, please remember to subscribe, it'll be very much appreciated. Let's start by talking about what is diversification. Oxford Dictionary defines diversification as the act of developing a wider range of products, interests, skills, etc. in order to be more successful and or reduce. It's a risk management strategy. And all it says is that instead of allocating all your capital into a single financial asset, you should diversify and spread out your risk across multiple different assets, such that your risk is not concentrated within a single product. Let's have a look at an example. So imagine our market consists of 10 different companies. So in this case, let's talk about diversification in the context of equity markets. So these are 10 stocks that we can invest in. And let's say that we have, I'm just gonna make some money up, just like the Fed, $1 million that we can invest into any one of these 10 companies. Now, without diversification, the problem that we have is that we do not know which one of these 10 companies will perform well and which one won't. So if we have to allocate the entire $1 million into a single stock, then we basically have to do a very good analysis, we have to do our due diligence to make sure that the stock we pick is an absolute best one that's available out there. The problem is that even if our analysis is exceptionally good, we still have the risk that A, it might be wrong, B, there might be external factors that we haven't considered which might make our investment not a very good one. For example, let's say that we decided that company number 6 is the best one out there and we invested the entire 1 million into this one particular stock. We might be correct in our analysis, company number 6 might be the best business out there, but due to company-specific risks, its share price might not perform as well as we would expect. For example, its management could have made some very bad decisions over the next couple of years, or the company might be in a specific industry that's currently undergoing some difficulties. For example, if company number 6 is an airline, and currently it's 2020 and the world is undergoing a global pandemic, no matter how amazing this business is, its share price is just not going to perform. And if that happens, we might be facing some significant losses, because we invested the entire 1 million into that one specific company. And if its share price isn't performing, well, our investment isn't going to perform either. What's more is that there is also a small chance that the company might even go bankrupt. If that happens, then we'll lose our entire deposit and we're pretty much done. We cannot play this game anymore. These risks are called idiosyncratic or company-specific risks, and they represent the risks that are unique to any particular financial security or an asset, in this case, stocks. And unfortunately, without diversification, we are fully exposed to idiosyncratic risk. Let's see what happens if we now actually try to diversify our portfolio. What we're going to do now is, instead of investing $1 million into a single company, we're going to break it down and invest $100,000 into each one of these 10 companies. And the great benefit of this is that it's much less important to be right about any one of these particular investments, because our risks are now spread out across these different 10 companies and they are no longer concentrated within a single stock. So this allows us to achieve two things. First of all, it allows us to reduce risks. Let's say that company number 6 has indeed been a poor performance. Fortunately, we haven't invested the entire 1 million into company number 6, but invested only 1/10 of that, which means that our exposure to these losses hasn't been as great as it's been before. Moreover, the gains from all these other investments hopefully will be great enough to offset any losses we made on company number 6. This means that the performance of our overall portfolio will not be significantly impacted by the poor performance of any individual investment that we've made. The second benefit of diversification is that it allows us to preserve our capital. Imagine that, as in the previous scenario, company number 6 actually went bankrupt. Well, in this case, we would only lose 1/10 of a million because we were not as exposed to company number 6 this time as we were earlier, and we would preserve the rest of our capital. Hopefully, the rest of the capital will be invested in this remaining 9 companies, and the return on those will somewhat help offset the losses that we made on number 6. Some of you might say, well, hold on. What if number 6 didn't actually go bankrupt? What if instead it performed exceptionally well? What if it was the stock that doubled or tripled in its value over the last couple of years? In that case, diversification actually hurts us because instead of investing all of 1 million into number 6 and gaining all those returns, we just diluted it by investing into all these other stocks. Well, while that might be true, the point of diversification is not to increase your returns. The point of diversification is to reduce risk. Yes, company number 6 could have doubled or tripled in value, and we would have made a lot of money if we went all in and invested all of our capital in that one particular stock. But in that case, we would be running a significant amount of risk. We would be exposed to company-specific risks, we would be exposed to industry risks, to market risks, and all of that risk would have been concentrated in one particular stock. On the other hand, if we diversified and reduced our exposure to company number 6, we would significantly reduce the risk of our overall portfolio, potentially at the expense of lower returns. Unfortunately, not all kinds of risk can be diversified away. No matter how much you diversify, some risk will always remain. This kind of risk is called market risk or systematic risk, as opposed to company-specific or idiosyncratic risk, which is unique to any given security. Market risk is related to the overall performance of the economy, and as such cannot be diversified away. So far we've looked at what diversification is. Right now, I would like to do something a little bit more exciting and actually look at how we're going to describe the behavior of a typical stock in our simulation. Specifically, I would like to break down the stock's performance into 2 different distinct components. Let's have a look. So the first component is called drift, and this represents the growth rate. So it represents all the good things that happen to the stock. So things like economic growth, the industry growth, the business growth, all these positive things are going to be bundled under the single component of drift. If I were to plot the chart of drift over a certain time frame, that is going to look something like this. It's going to be a nice upward sloping chart, exponentially upward sloping chart, that represents a certain amount of return per year. In the simulation, I'm assuming the drift to be 8%, which is just a completely made up arbitrary number that I'm just using. But what's notable about this number is that I'm assuming this to be positive. And it's a fair assumption because on general, stocks tend to go up. So if you look at a stock market chart of any big stock index over the last couple of decades, then you will see that on average it tends to slope up. So I think it's a fair assumption to assume a positive growth rate for stocks. Unfortunately, it's very rare that you can find a financial asset that looks like that. Very frequently it comes together with another component, which you all know and love, called volatility. And volatility is what makes everything difficult. Volatility represents the risk. So if I were to plot a chart of volatility, then it looks something like this. It's a chart that's sort of not really doing anything, it's not really going anywhere, but it's kind of all over the place. And this represents the uncertainty. So in financial markets, very frequently, risk represents uncertainty. And in this case, volatility is doing exactly that. It gives investors the uncertainty as to what their return is going to be in the future. With drift, it's very easy to know what your return is going to be. But with volatility, since it's completely random, you have no idea how much money you're going to make over a certain period of time. Another thing is that I'm also bundling all kinds of risks under this one component of volatility. So in this case, it represents the idiosyncratic company-specific risks, and it represents the market or systematic risks. So everything is just bundled under this one parameter. In addition to all this, what makes everything a little bit more difficult is that volatility is also typically much larger than the drift. In the simulation, I'm assuming it to be 16%. But because it's higher, over the short term, we tend to see that volatility dominates. And you need a very, very, very long time for the drift to actually manifest itself. So if you're investing over the short term, which is our lifetime essentially, volatility is going to be the dominant force. Another problem with this is that, unfortunately, you cannot just go to the stock market and say, oh, I really like this drift component, I would like to have a lot of this, but volatility, I'm a bit allergic to that, I would like to skip any of that and preferably not have any of this if possible. Obviously, that's not something we can do. And very frequently, these two parameters, they get bundled together. So when you go to a stock market and you would like to invest into this, what you're going to end up with is something that looks like this. So if we invest, I'm going to use a different color. So if we invest in a stock, then we're going to get something that sort of looks like that. So as you can see, it's simply just a combination of these two components. It's something that drifts up because of the growth rate, but it's not exactly predictable and you have a lot of uncertainty around its future growth. And that represents the volatility. And since volatility is such a dominant force over the short term, if you invest over the short term, unfortunately, you cannot predict your return in the future. And that's an issue. Is there something we can do about it? Well, there is, and that's the topic of this video. What we can do is we can diversify. If we combine a couple of these stocks together, here's what will happen. Assuming that all of these stocks have an 8% growth rate, we're simply going to combine their drifts as well. And since all of the drifts are positive, our portfolio is also going to have a drift of 8%. So that's good. But the volatilities, there's a very good chance that the volatilities might be able to cancel out. Because if the stocks that we've picked, if they're in different countries, if they're in different sectors and regions and industries, then ideally they will be exposed to different kinds of risks. And as such, their volatility parameter, their volatility component, is going to be different. And when one stock is exposed to negative risks and its share price goes down, the other stock might be exposed to positive risks and its share price will go up. And hence these kind of opposing risks will cancel out, leaving us with the drift. And if we add a lot of diversified stocks in our portfolio, then we might be able to offset a lot of different volatility effects. And we're going to essentially extract from all these different stocks the drift of 8%. So that's how it works in theory. Right now, let's have a look at the simulation, which I think is a very neat way to show how we can combine all these different stocks and reduce the overall volatility of our portfolio, even though each individual stock has a volatility parameter of 16%. So let's come to my desk and have a look exactly at how it works. So finally, the time has come to actually take a look at the simulation. Now, the simulation itself is just a simple program, and all it does is that it allows you to enter the values for drift and volatility, and based off on those parameters, it will generate a number of random stocks for you. What we can then do is we can combine those stocks in a big single portfolio and see how that portfolio behaves and what its characteristics are. If you want to follow along or if you want to play with the simulation yourself, you can find the link to this in the description below. Let's have a look. So this is how the simulation actually looks like. You can see at the top a number of different inputs that you can set. So for example, you can set the number of different assets within the portfolio, you can set their drift and their volatility. And at the bottom, you're going to see the chart. The chart will show you the performance of that portfolio, as well as the performance of each individual constituent stock within that portfolio. Right now, the chart isn't showing you very much because the drift and volatility parameters are both set to 0. At first, we're going to set the number of assets to 1. So we're going to explore the case where there is no diversification at all. We've invested the entire portfolio into a single stock. So first, what I'm going to do is I'm going to set drift to 8%. And as expected, the portfolio is now simply growing at 8% per year over the next 10 years. So nothing unexpected there. Now let's do something a little bit more interesting and set the volatility parameter to 16%. Okay, now we're talking. Now we're getting some action here. So what you're seeing right now is a randomly generated time series of this portfolio that has been generated using these parameters of drift and volatility. However, since it's random, the actual performance of the portfolio might not necessarily be exactly the same as those parameters that we set. So for example, at the top right, you can see the portfolio analytics. And the calculated return in this particular case has been calculated as 9% per year. And the volatility has been 17%. If I hit refresh, I'm going to get a different time series. In this case, the return has been 17% per year and the volatility is around 16. If I keep on hitting refresh, I'm going to see that first of all, the volatility of the portfolio is relatively stable. It's hovering around 16% and it deviates somewhere between 16% to 17%. And I can keep on hitting refresh and I'm going to see that it's fairly stable. However, the return Even though it's supposed to be around 8%, it deviates a lot from that level. And right now, for example, you can see that the return is actually negative 3%. So even though the drift of this underlying stock has been 8%, the volatility is so high that it brought down the return to minus 3% per year over the next 10 years. So volatility, as you can see, is quite a dominant factor in this particular case. And I can keep hitting refresh and I can generate time series where volatility has been in our favor and has been actually adding to our return. So that's without any diversification. And again, note that the volatility of the portfolio is roughly equals to the volatility of the underlying stock. Now we're going to set the number of assets to 2 and see what effect that has on the volatility of the portfolio. So I'm going to set number of assets 2, hit enter. So what you're seeing on your screens right now is, again, a randomly generated time series of 2 different stocks. These are represented by the green and blue line. And the performance of the overall portfolio, which is simply just an equally weighted average of the 2 individual constituent stocks. As I hit refresh, I'm getting a different time series. In this particular case, you can see that as one stock went up, the other one went down, and the overall performance of the portfolio has been relatively flat. What's important and interesting to note here is that now with 2 stocks, the volatility of the portfolio has dropped from 16% to around 11-12%. And again, I can keep on hitting refresh and I'm going to get different time series, but all those time series have a volatility parameter that is now around 10-11%. And again, as I generate more of these, I can see that it's 11.9, 11.4, 10.9. So my volatility is relatively stable, but what's interesting is that it has been reduced. It's less than the volatility of each of those stocks. The return of the portfolio, however, still deviates quite a lot from 8%. It's, in this case, 12%, 9%, 10%. So I'm still not able to exactly extract that 8% internal growth rate of each individual stock. What I can do now is I can keep on increasing the number of assets, and let's set it now to 3. So I'm going to set this value to 3, hit enter. So now we have 3 different stocks in the portfolio. And again, straight away, you can see that the volatility of the portfolio has now dropped from 12% to 10%. And again, this value is relatively stable. Right now it's 9%, 9.3%, 10.3%. So by including an extra stock, we were able to further reduce the volatility of the portfolio. Let's add some more. So let's go to 4. Again, you can see that the volatility of the portfolio has been reduced further to 8%. And I'm going to keep on doing that and see what happens to the volatility of the portfolio. So let's increase it to 5 stocks, 6 stocks, 7 stocks, 8 stocks. And as I do that, I can see that the volatility of the portfolio keeps on dropping. And right now it's around 4.2, 4.1, 4. I'm expecting it to go below 4% now. So it's 3.7, 3.7. So right now let's set the number of assets to 50. So my portfolio now consists of 50 different assets, and I can see that the volatility number has been reduced to 2.2%. So by including that many stocks, I was able to diversify and essentially significantly reduce the volatility of each individual stock of 16% down to just 2%. And I can see that the return of the portfolio is now relatively stable and it's around 8%. Again, I can regenerate these time series, I can hit refresh, and I can see that my volatility is relatively stable at 2% and my return is fairly between 7 to 9% every single time I generate the new time series. So by including more stocks, I was able to diversify. Now, the question I have for you is, if I set the number of assets to 500 right now, I'm going to get a very well diversified portfolio. And in this case, you can see that volatility dropped below 1%. So essentially I've eliminated almost all of the risk. The white portfolio line looks just a very smooth, exponentially growing line at 8% per year. And again, I can regenerate these time series again and again, and I'm still going to get the same result. Very low volatility and 8% growth rate per year. And the question I have for you is, how is that possible? How is it that I was able to include 500 stocks and I was able to completely, well, almost completely eliminate risk and extract that 8% growth rate? Because in real life, if I look at the S&P 500 index, which consists of 500 different stocks, and those stocks are also, you can argue, they're very well diversified. They're across different industries, across different sectors. But if I look at that index, its volatility is significantly larger than 1% that I have in my simulation. Why is that? What exactly am I missing in my simulation that allows me to achieve so much diversification and essentially eliminate the risk? Maybe there's some parameter that I can add to make my simulation behave a little bit more like real life. What is that parameter? If you know the answer, let me know in the comments below. If you don't know the answer, well, check the comments below. Maybe somebody posted the correct answer already. That's all I have for this video. Thank you very much for watching. I really hope you enjoyed it. If you found it useful, please remember to hit the like button. Please remember to subscribe. It'll be very appreciated. Thank you very much, and I'll see you in the next video.